Good afternoon. You ready, Husey?
I'm ready.
Good
I'm
afternoon,
ready. Yeah.
everyone, and episode 20, Taking Stock After the Bell. Just Husey and I today, so welcome. But
Extra special podcast.
But I mean, it's fair to say it's been quite a lot going on, isn't there? So I don't know where you want to start, really. I mean, it's November, so we're getting to the point now. People are thinking about kind of year end, and it's not been a brilliant year. It's been an okay year. We're up, but we've not made tons of money this year. But I think the big story of the week here, as we wanted to start, was inflation. Again, really game-changing stories. So we've got a chart here of UK CPI in blue, US CPI in red, and European CPI in yellow. And we had US CPI release on Tuesday, 1:30, and we had UK CPI on Wednesday, yesterday at 7 a.m. Both came in under expectations, and look at the drop in that blue line, eh? UK at 4.6%.
Rishi kept his promise, didn't
Rishi kept his promise. Well done, Rishi. Yeah, it was all your fault.
I mean, nothing to do with energy prices.
Nothing to do with energy prices collapsing and coming out of this. But this is so on both fronts, the markets were massively cheered by this because it looks like we could be getting back to what could be deemed normal. And we've talked before about the long-term prognosis for inflation, so there's no need to talk about that anymore. But in the short term, markets have been really pleased. So if we move on to, this was as at this morning, this is now what the market is pricing for interest rates in the UK in red and the US in blue. And we can see that those lines have now fallen, with the market now expecting rate cuts basically in kind of from June on next year. So
that seems to be the general commentary from strategists, isn't it?
But it changes, doesn't it? Because the data comes in hotter or colder, and therefore these lines move. But
it's quite surprised if you go back to the inflation chart. It's quite extraordinary, the increase in a straight line up, and then decrease sort of falls straight line down. Really, on the way up, I think, although we said inflation would fall away quickly, I'm not sure we expected it this quick, did we?
No. And everyone sort of said it was going to be transitory, and then it wasn't transitory. But if we look at this chart in 10 years' time, and we've had 10 years of roughly 2 to 3% inflation, it will look transitory on that time frame.
Yeah. So they were right.
Maybe they were. Maybe Jay Powell was right after all, and the last 18 months have been a waste of everyone's time.
The transitory period was a bit longer than we thought.
Exactly. But if we... so I think that's inherently good news. And I guess my only question from this point is that we've also had relatively weak labour market data.
Yeah.
We've had producer prices today that have missed. Yeah. Jobless claims have gone up a bit. Yeah. So at the margin, all the data's got a bit softer. So at what point does the market stop cheering the bad news is good news? And when does bad news become bad news? So what do you think?
I think the market will continue cheering bad news for a bit longer until inflation gets to a level where it's, we're a bit more comfortable with it. I guess really it's about unemployment, isn't it? I think if unemployment rate really starts to move, that's when bad news is bad news. But we have had some softening. I think I'm less concerned around the growth. It's more the unemployment figures that I think the market's really focused on. I'm focused on. Fed's focused on. I think that's what it's all about.
But for the time being, bad news is good news. As the chart, this is MSCI All Country World Index year to date. So we can see at the right-hand side of this chart, basically, the equity market was at a sort of high point at the end of July, and then we've had, a couple of months. October was particularly soggy, wasn't it? And equity market, particularly the US market, fell quite a bit in October. And then the last 2 weeks, it's ripped, isn't it? Back to sort of year-to-date highs, up 8%. This is in sterling terms as well.
We had a bit of technical buying anyway, didn't we, before the data?
Yeah.
Because we obviously had a very sharp sell-off following the horrific events in
the Middle East.
Yeah, the Middle East. So there was some natural buying that came in just on technicals, but the most recent spike has definitely been from that data. It's not just equities, it's, yields move pretty quickly.
Yeah.
US and UK as well. There's a lot going on as always.
Yeah, no, absolutely. But it's been, I'm not sure that we are prone to hyperbole on occasion, but I do sort of think sometimes that, weeks pass in markets where not a lot happens, and even sometimes months pass where not a lot happens. Can't help but think that the last week or two has been where months have happened. Data is softening, employment, inflation has softened, rate expectations have come down, equity markets have caught a bid, and not just the equity market, but year to date, the story here really has been, as we've talked about, the everyone's favourite phrase of the Magnificent Seven. So they have driven pretty much, as the chart shows, the Magnificent Seven have driven the whole equity market year to date. And if you hadn't owned Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta, formerly known as Facebook, you'd actually be down year to date without those stocks. But
has there been any broadening out at all recently?
Yeah, so the last
a little bit, isn't
yeah,
there?
so the last 2 weeks, the Magnificent Seven have underperformed the rest of the market. So you're seeing, I would say you're seeing the broadening out of the equity market rally in the last few weeks, because as we discussed before, these stocks are seen as investors as defensive stocks, aren't they? Because the growth is almost, not to people's eyes, guaranteed, because they are pretty resilient. So they've been the place to go and place to hide in a bit, as well as a bit of AI enthusiasm. Bit of bounce back for Amazon and Meta in particular, but
I mean, there's been a lot of stocks and sectors completely ignored because of the inflation worries. I think seeing that data will make investors look in other pockets, which is important. We can't just have this narrow leadership forever. It doesn't work.
No. No, totally, and that's why partly why I think the data of the last 2 weeks, not just this week on inflation, but a couple of weeks before that, and the softening, might have crystallised a kind of bit of rotation here. And everyone, the calendar shouldn't matter, should it, to investor psychology? But it absolutely does, because we've all got valuation points and we've all got performance to report on, and you just wonder whether fund managers who, I think if you judge some of the surveys, fund managers, generally speaking, have got quite a lot of cash relative to what they normally got, and that could very quickly be deployed into the rest of the
They did 2 weeks ago at the bottom.
Nah, exactly.
Have we got the chart on investor sentiment?
No, we don't. The Bank of America Fund Manager Survey, isn't it, where the cash weightings were at elevated levels 2 weeks ago, and the market was right down. So so it'd be interesting to see how this develops for year end, and whether the Super 7 have a little rest and the rest of the market catches up.
I mean, we've talked all year about it, really, haven't we? And we've had, the last couple of pods, we've had some really interesting people on. We had Jamie on the energy front, where there's opportunities there. We had obviously Dario on about wider strategy and sort of the themes that are coming up, but also we're talking about those long cycles, and prior to that we had various other guests as well. But it's sort of a lot of what we've spoken about is how do these 7 stop performing, or not just that, but how does the rest of the market broaden out, and where are the opportunities? We knew we were waiting for the data to get better, to have some of those moves. And I think some of that has happened. There's obviously a long way to go, but it's hopefully it's the start of it.
It's a bit of a chink of light, isn't it? So sort of how I think about it.
And I know it
can all go wrong, clearly, but
I know we'll come on to small and mid cap later on, but it's interesting to see how quickly, or it's a reminder of how quickly some of these investments can move when the data changes. Investors are ready to deploy cash in other areas. It's just we all want to see some certainty, or as much certainty as we can before we do it.
Before we talk about that, though, we talked before about the Magnificent Seven, how that's driven the market, and this sort of chart here kind of illustrates that. So our friends at Schroders done some work on valuations, and the blue line here is the cyclically adjusted price to earnings ratio, which is just a valuation metric of the US in blue, and the rest of the world in green. And the rest of the world in green looks 15 times earnings for the last 15 years, pretty much, whereas a US valuation has gone up quite a bit, mainly because of those big platform technology business and their valuations. But you look at this and you say, well, is this always going to be the case? And why is that? And this is a chart that I produced in a fact set here yesterday, which shows, it's a bit of a messy chart, but the top chart of the two is the return on equity. Now, return on equity is basically a measure of how profitable businesses are, and the blue line is the US and the red line is the rest of the world. And the bottom pane on the chart here is margins. And US companies, in blue again, generally have higher margins, i.e. for every £100 of stuff they sell, they make more profit relative to the rest of the world companies. And that, when I think about why US companies are more expensive, that's ultimately the answer, because they're more profitable and they have higher margins. Is that just tech, or do we think that's... I'm going to be interested to see this on like a sector neutral basis, right, where you adjust for the tech weighting. But what do you think about this?
I'm not sure it is just tech. I mean, there will be sectors that are outliers, but I think the one thing that US companies probably have as an advantage over other developed markets is, on the whole, there's more subsidies or support. I think taxes tend to be lower, don't they? But also employment law for companies is more beneficial. It's not more beneficial to employees because typically there's notice periods of anywhere between 2 weeks and a month, whereas the UK it's probably more like 3 months, and certainly in European countries like France and Germany, it takes a long time to change the size of a workforce and the business needs to move. I think that's probably a big reason.
They just have a bit more entrepreneurial drive as well, don't they? A bit more kind of... Is that fair, or is that a bit stereotypical? I mean, we just not as good as them at running businesses and making as much money. Is that what it is?
I think if you get it right in the US, just from where the US is positioned, but also the number of consumers there, it's just so much bigger.
It's a big old market.
Than in Europe. It's Europe even. There's always fine if you're part of if you're in the EU, then there's less trade restrictions or none in some cases. But there are lots of different countries and there are different rules. There's different legislative requirements. I think the US is
language and culture as well.
Yeah, exactly. It's one country. Essentially, well, it's states, isn't it? But the states are the size of European countries, so they do have a big advantage. And if you've ever read Tim Marshall's book, I know I've referenced it before, but Prisoners of Geography, or The Power of Geography, the book, it explains why the US has such an advantage in terms of transport links. It doesn't have to negotiate many rivers, mountains, things like that.
Yeah. The physical bits of it.
Moving goods around is much easier.
Okay.
If you're based in the US, I always think if you get it right in the UK, you've got a potential customer base of 60 odd million people. Now, if you get it right in the US, 350 million. Yeah. So
your potential growth runway is a lot higher before you need to start looking abroad.
And they've got again you've got you look to the south, you look at Mexico. I think for the first time since 2002, the US is now importing more from Mexico than anywhere else in the world.
I saw that. It's overtaken China. It's the biggest exporter to the US. But did actually.
What's interesting is 45% of the product coming out of Mexico was originally has origins from the US, so it's two-way trade.
Yeah.
So they do have a lot of benefits. They've got they can really utilize parts of South America and Mexico in particular with cheaper labor, cheaper manufacturing sites, and they that shift in terms of onshoring is happening. It's quite amazing, really. They've shifted so much away from China so quickly.
They have. And that was, Trump sort of kickstarted that with the trade war in 2016.
I think I saw 15% of goods imported into the US are now from Mexico. It's 15 or 16%.
It's a lot, isn't it?
But yeah.
But I'd say, when people, it's very easy to sit here and say US equities are expensive and the Super Sevens carry the market, and you don't want to be in those. But there are pretty good reason why we have American exceptionalism. And that is, they have got lots of attributes that are very, very positive for their companies. That's not to say that the US carries on outperforming the rest of the world, because it doesn't always, but it has done for quite large tracts of time.
The last time the US didn't outperform was 2000 to 2008
to 10. Well, yeah, the noughties essentially. So the US outperformed the 90s, and then that culminated in the dot-com boom, and then the US underperformed from 2000 onwards.
Yeah.
I haven't got that on the chart, unfortunately.
No, I'm just looking at margins, because margins were much closer, weren't they, in the noughties?
But as we will recall from the early days of our careers, and the noughties was all about financials and commodities and emerging markets, not about big tech and quality growth as a style. So no surprise that the US underperformed in that decade. But since then, since 2010, it's just been a one-way ticket, isn't it?
And actually, even if you look at JP Morgan as a bank, they've got the highest return on capital employed across the whole sector. Now, what is the reason for that? I think, there's a good piece the other day. I think it was in the FT. I can't remember, but it was essentially saying Europeans' banking problem is that there's too many banks. Actually, in the US, there's an oligopoly. It's a handful
at the
of
big
banks.
banks. They've got regional banks, haven't they? But
They do, but
the big
in terms of big banks, and again, they haven't had the same regulatory requirements that European and UK banks have had. So they haven't had to, if you look at a business like Lloyd's, or RBS, you've had, it really you had PPI, that was a problem a number of years ago. Every couple of years appears to be, there's always something, whereas the US banks don't have it, and hence why margins, or one of the reasons why margins are higher than.
So US is more business friendly, is that what we're saying?
I think
from
so.
top to bottom. You said, well, we've talked about, you mentioned the banks, and it's the same in the oil companies. The valuation on Chevron and Exxon are higher than the valuation on BP and Shell. It's not high. And Total. And part of that is cultural, but part of that is probably just drive. So, I don't know really. Answers on a postcard, everyone, as to whether the US carries on outperforming. I'm on the fence.
Very welcome to email in and give us your thoughts.
Yeah, we'll stay diversified for the time being. But no, I mean, we've talked before about the long-term prognosis, about higher inflation, about more sticky inflation, and maybe that, and higher interest rates, and maybe that suits a more ex-US approach than a US approach. But it's not obvious, is it? So I think we need to be open-minded. I think. How I view it. Yeah. And then we'll stick with the US. We'll look at small caps. US small caps here. This is the Russell 2000, he says, in blue, which year to date is basically unchanged, versus large caps, which is the S&P 500 in this instance up a lot, 20% year to date, and this was done yesterday or the day before. So essentially, large caps, as judged by the yellow line, doing much better than US small caps. Apart from this week, when small caps have caught a real strong bid and have really kind of bounced this week, haven't you? We thought any, keen to buy a few small cap US equities over large cap opportunity here? Do you think?
I've been keen for a while.
You've been keen before it started underperforming.
Yeah, I think there's been a lot of, we spent a lot of time looking at the difference in valuations and where the opportunities are, and I think we all know why small cap has struggled in this environment. They're impacted more by rising rates. They're impacted more by inflationary pressures. They're probably not in some ways they can't move as quickly as larger cap stocks. And obviously you've had this theme of you've had the Magnificent Seven that have just continued to drive upwards. But on a relative basis, I think there's an extraordinary amount of value in US small cap.
They're typically more sensitive to the economy and a bit more
they
cyclical.
are more domestic focused.
So if there's a recession, small cap generally gets hit a bit harder.
Yeah.
So I wonder if some recession risk is in that. And
yes.
And debt as well. So they
Absolutely.
probably have to worry about debt more than the likes of Microsoft and Apple do.
Yeah. Well, they'll be refinancing at higher levels. They probably can't refinance for as long. So I think duration is probably shorter in small cap.
That's probably right.
Different, also I'd say different sector.
Sector composition.
Yeah.
Less tech.
Exactly.
Regional banks are in the small cap, aren't they? Now.
But I think, the differential between small and large is the largest it's been since 2009. As we were discussing earlier, as you enter a recession, the prevailing 3 to 4 months, or I think it was 3 to 5, on average, small cap is sort of plus over 20%. And as we were discussing earlier, that feels, in some ways, that feels strange that you're going into a recession. So things, the economy's feeling worse. So why would it do that? But actually, to get into a recession, it's all backwards looking. Actually, small caps are already feeling the pain now. They're moving supply chains, they're restructuring labour force, they're potentially cutting costs. So actually, probably as the recession hits, they've already done a lot of that,
and the stocks have already sold off into it.
Exactly,
the market knows a recession's coming.
Yeah. So investor sentiment is as low as probably as low as it can be. Yeah. So that's why you get that very quick drive upwards. But it's brave. It will be probably feel counterintuitive to a lot of investors to buy small cap
as a recession's coming.
Yeah.
But, no, I agree with that. But if they've already been horrid for 6 months before that, which they have in the US.
And UK.
Well, talking of UK, so talking about looking horrid, have a look at this. So this is UK small cap going back 5 years. This is the Numis Alternative Investment Market Index, to give it the correct name. And obviously it fell quite a bit in the pandemic. And then it rose quite a bit. But since then, it's down 40% from its peak. 18 months ago, 50% nearly. I mean, small cap stocks down 50%. You're talking, 2008 kind of amounts, aren't you?
And
you buying these?
Well, we've seen other people buying them, haven't we? Today?
Well, this week we've seen on the inflation news, they have all ripped. They're up between 5 and 10%.
And in terms of M&A, people are coming in. So Hotel Chocolat.
Hughes' favourite shop.
If you bought a few presents from Hotel Chocolat.
There's one at the Paddington station, rather helpfully. So
is there?
So if I ever need to get into,
if you're ever in trouble,
I'm never in trouble.
Oh no,
just in case, it's 30th of November. I need an advent calendar.
I thought you'd be going home via Harrods to buy the Louis Vuitton handbag.
Have you seen the market this year? I'm definitely not going to Harrods. Definitely not going to Harrods. I mean, Hotel Chocolat, big news that.
Yeah, we had Young's Breweries were buying
the City Pub Company. Yeah. They've got quite a few nice little pubs around here, haven't they? Maybe we should do a tour. We should take the pod on tour.
I think we should take the pod to the pub.
That's a great idea.
Alex would like that.
Alex would be a big fan of that. Yeah, we'd get some more guests on that way as well, wouldn't we? Rather than just listen to us two. But no, it's really interesting. So Hotel Chocolat, 575 million? Stock's been horrible.
Oh, it's been awful. It's. I mean, they had a big profit warning, didn't they? And that's it's part of the reason for the valuation fall. But I mean, it's a big premium. I think £3.75 was the price, up about just shy of 200%.
Yeah, but it's bought by Mars, the big US confectionery conglomerate, to give it its proper name. And I just think this is really instructive because these stocks are cheap, and if the market, the equity market, doesn't recognise that, then someone in private equity with a spreadsheet will. And in fact, we've just pulled up the chart here so we can get this kind of added in. Here's a 5-year chart of Hotel Chocolat, and the share price was £5.50, and it got down to £1 in August, and it's been bid for at what, 360 odd?
I think it's 375.
375, yeah. Shares are now trading at 362. Yeah. So that's extraordinary, isn't it? But if there are, but
this will happen. It's this isn't a standalone business that's sitting very cheaply and nothing else is. I mean, the price of small cap is really on the floor. Yeah. Mars largest owner of pet food in the world.
Are they?
Yeah. So I expect Hotel Chocolat.
Where are you going with this?
Hotel Chocolat is going to have some dog treats.
Dog treats. Well, you can get. My sister-in-law sent me a photo the other day, and she was she was in a restaurant and a hotel. They stayed in Bristol because they were flying from Bristol Airport, and the restaurant had a doggy menu, including doggy ice cream and loads of treats for something ludicrously overpriced, like £7.50 each. We really need a recession to get rid of that stuff. Yeah. Anyway, so Hotel Chocolat, Young & Co is buying City Pub Group. Yep. These businesses are cheap. I don't know. Is that the catalyst? Is it just, and then a little bit of good news on the inflation interest rates front? Maybe we don't get a recession in the UK because sentiment's pretty bombed out.
I think even if you do, it's look, if we're going into a hard recession and things are properly gloomy, then of course this stuff is going to get a lot worse. But that's not what the market's anticipating. I think even if we go into, in some ways, I still feel if we go into a small recession, there'll almost be a cheer that we're there. We don't have to talk about it or worry about it anymore. And we're in the teeth of it. And actually, the market's very good at looking through things. If the recession is soft, it will look through it and we'll look to the other side. And that's when this stuff will move. And I'm not for a second suggesting we should have big weightings to, small and mid cap. But yeah, I think any diversified portfolio should have something in there. It's obviously down to.
I think that point about recession is quite a good one, because for lots of us, recession, we get kind of PTSD back to the financial crisis. And the financial crisis is not a normal recession. That was almost a depression. It was a great financial crisis, losing the name. If you look back at the 90s recession in the UK, it was just about had one in 2001, didn't we? Wasn't the end of the world for most people. Clearly not great. No, but if you have a run-of-the-mill recession, most of these stocks are probably cheap enough to weather it. They probably get cheaper in the short term, don't get me wrong.
But you're right. It's, I think a lot of people that are managing money today, or investors, will remember we've been working during the financial crisis, or certainly have read about it. And that, I think that's why investors are so petrified of recession, because in reality, take away the small ones we've had since. COVID wasn't really a recession. It was obviously enforced because we were all stuck at home. But we sort of go back and think a recession is what happened in 2008-9, and that's not a normal environment. No. Recessions, we can carry on investing through recessions, and it's not the end of the world. Maybe it's like thinking about the Great Fire of London. Not every fire is like the Great Fire of London, is it?
No, we were in Painters Hall this morning for the roadshow, and that was initially opened in 1532, got burnt down in the Great Fire, rebuilt 5 years later, and then got flattened during the Blitz in 41. So the current Painters Hall is the third incarnation. So that story went down pretty well with the audience when I told it.
That's good.
I thought I did my work. And just to tie a bow on this, Montanaro happened to send me a chart about the valuation on UK small cap. And this is Schiller PE, and I don't necessarily need to go into detail what Schiller PE is, but basically it's a type of valuation metric that we look at compared to the ordinary PE. And it's fair to say that UK small cap looks as cheap as it's done since February 2009, before that March 2003, August 92, which is even before your time. And buying UK small cap at those points in time, I don't have the data on me, but I'm going to say they were probably quite good times to buy UK small cap. You get a little bit cheaper, of course it can, the world can change, and the sample size here of 3 isn't necessarily a done deal. But you as we've said, there's lots of bad news in these stocks at an aggregate level.
There is, and you've had in lots of places earnings downgrades as well. So you've had earnings fall and valuations are still very cheap. So share prices
down 40,
are not
down 50.
They're not looking through this yet, and they will. It's not small. There are opportunities in small cap where small companies grow into big companies, and there's huge amounts of shareholder value.
Do you want to name a few? Got to name a few high-profile examples of UK small cap that have developed into proper, fully fledged businesses.
Well, we almost had ASOS, but it got very small again, didn't it?
Went from 10 million to 2 billion, and what is it now? 500 million. Domino's Pizza.
Domino's Pizza
out on AIM.
Yes. On AIM.
Domino's was on AIM. Jet2 Holidays is worth 2.5 billion.
That's still on AIM.
That's still on AIM. Amisha told me today, actually, we should have her on maybe. The only reason it's still on AIM is because the chairman owns a big slug of the company. He doesn't fancy paying the IHT bill, which is classic. So there's a few big stocks.
JD Sports was very small. I don't know if that was ever AIM.
I don't know. Kane Energy, which has now disappeared.
Yeah. Ocado was very small.
Oh yeah, that was on AIM, I think. So yeah, I mean, from small acorns, mighty oaks grow. Is that right?
I think
so. Did I get it right? So the other news, which is interesting on UK small cap, is some chat around what the government might do to encourage investors to buy more UK equities. And there has been this idea of a British ISA floated around.
That. Yeah.
I'm not 100% sure of the proposed mechanics, but essentially it's either a separate ISA or your existing ISA. You have to invest it only in UK equities, and particularly UK small and mid cap equities.
And is the idea that you're having an additional allowance to do that with?
Either some of your existing 20,000 allowance has to go into a British ISA, or possibly even all of it, or I don't know, if I'm honest, but it's total speculation. So please don't think that anything that we say on this podcast on that front is given.
Advice?
No. But there have been the Mansion House reforms, haven't there? How government are trying to encourage pension funds and investors to invest in UK small cap, because if you don't have thriving small cap market with decent valuations, these companies can't issue equity because they need equity to grow and they need to expand and build, etc. So it is important, and I think Peel Hunt had quite a big report about it, which I kind of scrolled through, and they talked about in the US, the tax advantage wrappers in the US, like 401k plans and IRAs, individual retirement accounts. They do have quite strong restrictions on what they can buy, and they have to be US.
Is that right?
Yeah, I mean you can, but so there is precedent, and there's something in Japan and there's something in France that they have their own similar ISA type wrappers, and they are limited to their own pool of investments, or there are restrictions on what you can buy. So it's not unprecedented if you were to see we're going to call them Bryces. Is that the name? I'm not sure. I mean, mechanically, from our perspective on a day-to-day basis, obviously lots of clients have got ISAs and they've got very diversified portfolios. So if we were told that all of a sudden we have to sell out our US equities and ISA accounts, that might not be ideal. But
at least there'd be no tax implications.
Oh, true.
No, it wouldn't be ideal. Surely it would be an additional allowance.
You'd think so. But the autumn statement's next week, isn't it? So
yeah,
this comes back to the sort of, think about a bit about catalysts. Well, small cap's cheap. You've got a couple of takeovers. Inflation's down. I feel like a broker here, kind of peddling UK small cap. And just for the record, I do own some small cap PA, UK small cap equity.
I've got some in my pension.
Have you? Yeah, well, there we go. So, I mean, that's probably all I want to say about that. We have kind of done that to death. But yeah, when I was talking to Amisha today, who runs our AIM portfolio service designed for inheritance tax, and she's, banging the table about how cheap some of her stocks are.
Yeah, no, and she's right.
I had a really tough time, but
she's a bit more chipper over the last week.
Yeah,
following some pretty decent moves in benchmark and portfolio. But
right to say,
it's been a very. I think it's that saying, isn't it, that things often carry on for a lot longer than you'd ever expect. I think the environment we're in has carried on for a lot longer. It's been a lot harder and a lot longer than any of us anticipated. But we've said it a few times that we feel we're getting towards a change in sentiment. But
maybe this is it. Maybe this isn't it.
Yeah.
I don't know. Maybe I'm wrong. But I do sort of feel as though the last week has been pretty material in terms of change of environment. But we'll have to see. But what are clients saying? What are clients saying to you when you're meeting up for your review meetings?
I think it's an acknowledgement that it's been a very hard couple of years, and in most cases, clients are very understanding. I think the thing we've been discussing a lot is there is a return now for savers.
Bonds.
For bonds, we don't have to use alternatives or run, potentially have more equity, than perhaps they would normally have. And in lots of cases, we've, more money's been transferred in to take advantage of gilt prices, particularly
gilts rather. People are taking out cash.
So that's been good. From a starting point, if you think about a 60-40 portfolio, you're 40%, you can get a return on risk-free investments as such, which are short duration gilts or bonds.
Did you come to the roadshow this morning and listen to my keynote speech?
I did not, no.
That's basically what I said.
Did you?
No, I mean, you can get 4.5% on gilts, and you can get 6% on corporate bonds, and equity markets and aggregate are not expensive.
Exactly. So
it's been a tough couple of years. Really tough.
And they're the conversations with clients. I think if we think about it, we've gone through COVID, we've gone through the fastest tightening cycle we've seen for decades. We're dealing with inflation, levels of inflation not seen since the 70s. We have been through an extraordinary period, and actually, portfolios year to date or year to year are mildly positive, and considering what's happened, I think in most cases clients are fairly pleased isn't probably the wrong word. It's probably not the right word, because everyone wants to receive much higher levels of return, but I think are very understanding with how hard
relieved as well.
Relieved is relieved is a better word, because it has been very difficult.
But we've probably all had a few questions about should I just go to cash and stick my money in deposit for a year at 5%? Well, I mean, interestingly, we've talked about the last 2 weeks. November alone, it's the 16th of November today. I checked this morning. Balanced portfolios are up the best part of 4% in 2 weeks.
Yeah.
So you don't need a lot of good news, because investment returns are inherently lumpy. They're not linear. So we talk about equities doing 8% a year and bonds now doing best part of 5% a year. But equities don't give you 8% each and every year. They don't give you 1% a month, do they? They give you get periods where they go down, periods where they go sideways, and then these relatively short periods where they go up quite a lot.
Yeah.
And I think one of the points about equity investing is if you want to harvest those returns, you can't pick and choose, because you're likely to miss out. And we've seen that in the last couple of weeks.
Well, I think listening to podcast over the weekend, I drove up to Sheffield to see my sister. It's my nephew's birthday, so and I had something on whilst my son was watching his.
Uncle Husey bringing the birthday presents.
Yeah. Whilst my son was watching, I can't remember what he was watching, Paw Patrol or something. I was listening, and if you'd missed, I think, the 6 best days in the S&P this year, you'd be -1.
Yeah.
Whereas actually, if you invested in those 6 best days, you were, whatever the US plus 14, 15.
Yeah.
So, I think those meetings this year has been, it's hand-holding, and it's giving clients the confidence to stay invested by explaining actually what the businesses are doing. Because I think in most cases, our businesses, the businesses we're invested in, have done a really good job. And I was reminded of something else as well, which is management teams of companies, their number one focus, whatever they say, is on getting share prices higher. Because
because this morning as well.
Did you? That's because I wrote your presentation.
Yeah, thanks very much.
But
Tim Cook gets up in the morning and goes to work to get the share price.
Of course he does.
Not directly, but indirectly through everything he does.
His income and earnings are linked to share price, and it's the same. That's why management teams have long-term incentive plans.
Yeah.
It's whether it's based on growing revenue or EPS or share, whatever it is, it's all linked in some ways to making the business better. So, and I think as investors, sometimes we forget how fortunate we are that we can invest alongside these brilliant people.
Yeah.
And in reality, not do any work for it.
Right.
Exactly.
Yeah.
You just invest in a good company and enjoy the benefits. And it's always something that Buffett and Munger have said.
Sounds so easy, doesn't
it? It does sound so easy.
Goes up, starts on the bottom left, ends in the top right.
As we discussed with James Ashley recently, it's that we are in a world of there is more risk in terms of geopolitics. It's more uncertain because inflation is we're not used to these big ups and downs. We're not used to thinking about what rates are going to do. I think turn the clock back a few 3 years ago, most people wouldn't even a lot of investors wouldn't even know when central banks were meeting to discuss what rates were going to do, whereas now everyone has the data in the diary.
Well, no one really cared about the inflation data.
There's no point.
But kind of on that point, and if you look at what's happened to bond yields and interest rates in the last 18 months, had we gone back to the end of 2021 or early 2022, and you'd said to me rates were going from 0.5% to 5.25% by the middle of next year, I'd have said, we're probably down 25-30% across the board.
100%. Yeah.
And we're not. All right, we're not made tons of money. We've not made much money at all in that 18, 24 month period, and it's been a struggle.
Yeah.
And last year at times was pretty shaky.
Yeah.
But we have coped admirably. And to come back to the point about a traditional equity and bond portfolio, looks really good from here.
It really does. And then
UK
you've
small
got
cap looks even better, right?
and investment trusts. We like a discount.
Yeah. Love it. He usually loves a discount.
Why would you not want to buy assets cheaper through an
Well, that's true.
investment
Some
trust?
of those infrastructure names drop about, and the property names drop 10% in a week.
And look, in a month they might be down 10% again. But I think we can see how the market will react with inflation at tamer levels, and when we have a view on where rates are going, because a lot of the infrastructure investment trusts are driven in price by rates. That's the main variable for them. So, these things move quickly. So no, as always, it's exciting, isn't it?
Yeah, it is exciting. I'm pretty excited, despite the last 2 years of being what felt like being punched in the face every day. I mean, you had hair 2 years ago, didn't you?
That's slightly.
There we go. Should we call it a day there, Husey? Do you think?
Yeah. Should we do a?
Should we do a little advert? So next week we've got 2 weeks time. 2 weeks time we've got Freddie Late, who's the fund manager and head of Latitude Investment Management. He runs a globally focused 30 stock portfolio.
He does, with a real value tilt, which there's some brilliant businesses in the fund, but he does start with valuation. They've got he'll talk more about it, but a pretty scientific approach and real in-depth analysis on how they look for stocks. Perfect for me. I won't say much for the hour. So
no, that sounds good. So hope you've enjoyed today, and hopefully it's been a bit more positive, because the news has been a bit more positive. So I think that might be reflected maybe certainly in my mood this week. It's been great. Long may it continue, but of course it might not continue, because past performance is no guide to future returns.
That's correct.
But with that, thanks for joining us. Any questions, difficult questions, james.hughes@quarterchievia.com, and I'm jonathan.raymond@quarterchievia.com. And thanks very much for your time, and we'll see you next time.